If you talk to our companies, they are becoming more cautious. Their CapEx plans are being lowered, their hiring plans are slowing, and so we see this happening with a lag. I was talking this week with a developer of apartments who's building this year 15,000 units across the U.S., major developer, and he said next year he's cut his plans by 75%.
And that was Blackstone President and COO Jonathan Gray. Let's bring in our next guest, who says it's hard to see a bottom without a correction in earnings. With us now we have Julia Lee, APAC Equity Investment Strategist at State Street Global Advisors. And Julia, I just want to return to those remarks from Blackstone there. Is this something you've noticed as well? Are companies becoming more cautious? And what is this telling us about whether or not we've found a floor in markets yet?
Well, we're in the middle of third quarter earnings season in the US, and I think the thing that really stands out is the lack of downgrades that we've seen. We've seen commentary around still a very strong economic backdrop, and this is exactly what the Federal Reserve doesn't want to see. We have a look at historically where the market has bottomed out. We have traditionally seen an earnings correction come through. So if we have a look at previous recessions, you usually see an earnings correction of around about 30 to 50%. But in the market at the moment, consensus forecasts for 2023 still positive. So this earnings season is going to be very important, but watching for at least some sort of earnings correction to come through before the market sees a real bottom.
Is there a possibility we don't get that correction that you're talking about?
I guess if we have a look at expectations, the focus has been so much on inflation. And as recently as this week, we've seen US, Canada, as well as UK inflation much higher than expected. And I guess the question that the markets are asking is, where is inflation going to peak? But I think the more important question for markets to be asking is, how long is high inflation going to stick around? Are we going to be battling through it all throughout 2023 and also into 2024 as well? So it's not just the rise in interest rates, but how long those higher interest rates are going to stick around, which I think is going to be problematic for markets. So while we're focusing in on the here and now, I think the medium to long-term outlook is where the earnings correction is really going to happen.
Given the uncertainty that you talk about, we continue to hear from investors that you need to stay defensive, that you need to go up in quality. But then I have to ask, how difficult is it to really pick the right stocks at a time when everything seems to be moving in tandem?
I think that's the difficult at the moment. When you see asset correlation, the highest that it's been in more than a decade, it makes it very difficult for money managers. There's a few options here. You can choose to be the market, or you can try and get a tactical edge through things like sector allocation. And we've done a piece of work from 1961 looking at different phases of the economic cycle and which sectors do tend to outperform. And unsurprisingly, going into that recessionary phase, it is the utility staples sector as well as the healthcare sector which outperforms, and we've been very positive on those sectors from the beginning of the year, and we continue to be very positive on that defensive positioning, and then add in energy, which we're also positive on. But I think for investors it helps in this type of market to look through a short-term, a medium-term and a long-term lens, because while we're saying medium and long-term still positioned defensively, we know that short-term there are tactical opportunities. The market is so bearishly positioned when it comes to high allocations to cash and low allocations to equities, and we know that sets the stage for very strong bear market rallies as well. So definitely opportunities for short-term tactical positions, but staying defensive medium-term.
What about allocations to different regions? How diversified are you in terms of geographies?
That's a very good question. We center so much on the US, we forget that there's a lot of positive things going on around the region. If we have a look at Australia, Singapore, Japan, these are all markets that have outperformed. Now in Australia and Singapore, there's very high yield, and we know in terms of factors, high yield, low volatility, quality as well as value has outperformed. So with the high yields in these countries, that's acted as a buffer to the volatility that we've seen on the capital side. And of course, Japan, we've seen that weaker Japanese yen, the weaker interest rates, meaning that Japan is marching to a different tune. Add in that valuations are much lower in the region. In the US, while we've seen the PE ratio multiples falling from about 27 down to 17, around the region, multiples are much lower, with Singapore around about 11 and Australia around about 15. So I certainly think there are shorter term opportunities as well as medium term opportunities emerging around the region, and that there are different drivers as well, not forgetting that China's also in a different part of the cycle.
Yeah, you mentioned China. How much do you have to pay attention to the geopolitical implications when, on a day like today, for example, Bloomberg has learned that the Biden administration is planning to really expand those export controls even to quantum computing and AI?
Well, it does look like those tensions are only escalating, and it's been a very difficult year for China, especially because of not only the property market in China, but also the zero COVID policy. So I think for investors, they need to ask what could possibly change in 2023 and 2024. Are we going to see an escalation in terms of the very slow growth that we've seen in China, or are we going to see China turning a corner and better growth coming out? We know that looking at other experiences and other economies, that once economies and countries exit zero COVID, that economic growth and rebound is very rapid. So while things are very bearish at the moment, I think the key for investors to be asking themselves is what could be different in 2023 and 2024, and that we could be seeing tailwinds here coming through for China.
Julia, before we let you go, I just want to ask you about one of your sector calls, and that is energy. You're positive on this space, and we did hear from President Biden yesterday also chastising energy companies and oil companies for engaging in share buybacks, returning money to shareholders instead of investing production. Do you feel like maybe there's an implicit suggestion here that there might be some sort of policy response coming beyond just releasing oil from the strategic reserve?
Well, Paul, we know that President Biden is trying to get down the price of energy over in the US. And if we have a look at the impact on oil prices so far, they've been extremely resilient. In fact, if we have a look at the energy sector, this is a sector where we're still seeing upgrades to forecasts coming through. At the moment, the consensus is for growth of 146% in earnings next year. And not only that, we're still seeing reasonable valuations in this space as well. So energy, despite I guess the US's attempt to bring down costs, we know there are supply side challenges, and given the attractive valuations and still upgrades coming through, I think it's an unusual space when we're probably seeing downgrades coming through for the rest of the cyclical space.